When do you think you first realized that the shale revolution was actually a revolution?
I don't think there's a single like aha moment where I had this realization that what we were going through was going to be a massive market cycle that we would be studying at some point in the future. I think if I had to pick a specific moment for me, it was probably in 2014 when I was in a meeting with some of the most senior people in the Mexican government and Pemex, and the national oil company. And I was basically explaining to them how Shell works in the US. And this is right after they passed this big historic constitutional amendment to change the constitution to allow for private investment in oil and gas assets. And that hadn't been the case since 1938, right? So it was a big deal. I think somewhere around there is where I would maybe pinpoint this. Like, this is a big thing that we're living through. What about you?
Yeah, for me, it was about 2013. I was Blackstone's high yield oil and gas analyst, and for about 6 months straight, I was looking at 2 and 3 and sometimes even 5 new high yield deals a day, what are called drive-bys, where a company comes to market with a high yield offering and closes it on that same day. And so, on occasion, five new deals a day from the oil and gas space in high yield. And these deals are they're getting issued on the same day. They're trading up 2 and sometimes 3 points on the same day. So 3% up in a day for a bond.
Wild.
And that's, a couple months straight of that. And you're sort of like, okay, this is not normal. Something revolutionary is happening here.
Drive-bys.
That's right. All right, ready?
Ready. Let's go.
Let's do it. At the end of part 1 of this series about the shale revolution, Devon had just acquired Mitchell Energy for $3.5 billion in 2001. Devon had become convinced that the Barnett Shale was real and that Mitchell had cracked the code on how to get gas out of it economically using fracking technology. So that's the genesis moment of the shale revolution when it comes to technology. The real boom in capital and production growth doesn't really get going until later on in the decade. And this is the story of one guy, Aubrey McClendon, who catalyzes the boom in natural gas. Alan Greenspan, chairman of the Federal Reserve from 1987 to 2006, in June 2003 testified before Congress on the state of the natural gas market and really just the lack of natural gas and how big of a concern this was for everybody in the country, including policymakers. So here's the excerpt in Alan voice. In recent months, in response to very tight supplies, prices of natural gas have increased sharply. In the United States, rising demand for natural gas, especially as a clean-burning source of electric power, is pressing up against supply essentially restricted to North American production. Yesterday, the price of gas for delivery in July closed at $6.31 per million BTU. That contract sold for as low as $2.55 in July of 2000, $3.65 a year ago. Market expectations imply a 25% probability that the peak price will exceed $7.50. Today's tight natural gas markets have been a long time in coming, and futures prices suggest that we are not apt to return to earlier periods of relative abundance and low prices anytime soon.
That's great. This is Gilbert Gottfried instead of Alan Greenspan. Do you know who that is?
Yeah, that wasn't the best Alan I've done, but
Love it.
Nonetheless, that is the perfect summary of the investment thesis underpinning the Aubrey McClendon story and how he became one of the pivotal leaders driving the shale revolution.
I think it's actually underpinning the whole shale revolution, right? I mean, the expectation that supplies of energy were tight and we're going to be for a long time.
There was a thing called peak oil and peak gas not long ago where people thought we were essentially running out of the stuff.
Yeah.
And so who is this guy, Aubrey McClendon? Aubrey McClendon was born in July 1959 in Oklahoma City, and he's got some aristocratic roots. His great uncle is Robert Kerr. Robert Kerr is famous for 2 reasons. One, he's a co-founder of Kerr-McGee, which is one of the big prominent oil and gas companies of that time. Kerr-McGee actually drills the first commercial offshore well in the Gulf of Mexico. And Robert Kerr is governor of Oklahoma from 1943 to 1947, and then he's a senator from 49 to 63. And so Aubrey McClendon comes from this Kerr family. And as a child, you start to see some characteristics from Aubrey that he carries through his whole life that are really important to who he becomes and therefore how the shale revolution plays out. He's fiercely competitive. He's very gregarious. He's a very popular kid kind of all throughout his childhood. He's co-valedictorian and president of his high school. He goes to Heritage Hall in Oklahoma City, which is one of the best, if not the best, private school in Oklahoma. As a kid, he's a natural salesman. He's also got an obsession with maps and geography from a young age that I'm not sure where it came from. I never came across anything that he like picked it up from a relative or something like that. But from a young age, Aubrey McClendon was very into maps and geography.
It's important to note too, Matt, that Aubrey's not some oil baron's kid growing up with a silver spoon in his mouth. I found it interesting that his dad, Joe, worked for Kerr McGee for 35 years on actually the downstream side. So he's not putting together oil deals. He's just on the kind of refining and moving product side of the business. He's a normal, steady company guy, and he spends a lot of time with the kids. And he's a fun, content, relaxed dad. His mom, on the other hand, a stark contrast, is very intense. And apparently this was true of the whole Kerr side of the family. Aubrey, I think, inherits a lot of these traits of competitiveness and this drive. And so he was super entrepreneurial, and he was, selling papers and mowing lawns and constantly figuring out how to make money so that he could go do the things that he wanted to do.
Aubrey McClendon at this point in his life is not a spoiled kid, right? He has a great education, and he's working hard, and he'll continue to work hard and earn his way. Aubrey goes to college at Duke, and his popularity just continues. My read is he's kind of the life of the party at Duke. He's rush chairman of his fraternity. At Duke, he meets Kate Upton Burns, who ends up being his wife. Kate is an heiress to the Whirlpool family. Whirlpool is a $12 billion company today, and so you have a little bit of a power couple forming here early in college. Aubrey graduates from Duke in 1981. He had majored in history and minored in accounting, and he was all set to go be an accountant at Arthur Andersen in Dallas. But his uncle offers that he come back to Oklahoma City and be the staff accountant at his independent oil and gas company called Jaytex. At the time, Jaytex was just a very classic small independent oil and gas company, drilling wells all over Oklahoma and Texas, searching for oil and gas. And Aubrey comes into the oil and gas industry at just the most interesting time. December of 1981, so just a couple months after Aubrey graduates from college, rig count in the U.S. hits an all-time high. Rig count is a proxy for kind of activity levels in the oil and gas space. And it gets up to a level where it's actually 2 times higher than it's ever been, and it's 2 times higher than it's ever going to be after it comes down. And the reason for this is that the Iranian Revolution had knocked out Iran's production shortly before this, and so oil prices have gone way up due to lack of supply because Iran was 10% of global supply of oil and gas. That'd be like losing Saudi Arabia or Russia from the global oil supply today.
Which, for the uninitiated, 10% might sound low, but it is a massive amount to come off the market for a market like this.
Right. These are very inelastic markets. It's interesting, though, because this drilling boom is happening towards the end of Paul Volcker raising rates to above 20% to kill inflation. It's interesting because drilling for oil and gas is very capital intensive. And so you'd think policy rates at 20% would equal, no drilling, not an all-time high in drilling rigs. And so 2 things. One is these kinds of projects get financed a good amount ahead of time. And so it takes a while for these higher policy rates to make their way into actual industry activity. And then 2 is that even though policy rates were very high leading up to this, real rates were actually negative until 1981, meaning that policy rates were below inflation. And so said differently, borrowing was effectively free until real rates got positive in 81. And so Aubrey comes into the industry during this sort of boom and almost sort of blow-off period towards the end of an oil bubble. He's in accounting for 9 months, and then he gets transferred over to the land group. In the land group, they're acquiring land and leasing land for the company, and presumably he gets transferred over there because it's just a madhouse in his first 9 months. Like, they just need bodies and land to do more deals and get more rigs drilling and all that stuff. But then not long after that, the oil patch hits what's called the Gulag period, the first half of the 80s, where Volcker's finally able to get interest rates above inflation. And that completely kills lending to any capital-intensive business like oil and gas. And it causes just a gruesome recession, which destroyed demand. This is probably one of the
bleak.
This is probably one of the best examples of stagflation when you look at the period, because oil prices are still very high compared to history, but unemployment's really high and the economy's performing poorly. And actually, most oil and gas companies go out of business during this time, including Jaytex. Jaytex is kind of right in the target for the kind of business that's going to go under during this time period. So Aubrey's in his early 20s at this point, right? He's 22, 23. He's newly married. He's just out of Duke, and he doesn't want to leave town, right? He's home in Oklahoma City. And I think one thing that's really important at this point in the story is he's kind of found what he loves to do in the land gig. Here's a quote that I read about his time in the land group at Jaytex. He said, "That's when I fell in love with the oil and gas business because the land business, in my opinion, combined my love of history with my love of precision of numbers and maps. When you figure out who owns what minerals underneath the surface, there's a lot of math involved, and I like that. History, accounting, maps put together equals land, and that's what I loved." And so at the age of 23, when Aubrey probably could have, kind of dodged this terrible recession and even gotten out of the industry that was, clearly super volatile, he decides to set up his own independent land office. And so he buys a typewriter, he buys some maps, he rents an office, and he becomes an independent landman at the age of 23.
And Matt, we already saw this as when he was a kid, but again, this is just the pattern of Aubrey's personality of being very self-assured, knowing what he wants, and rather than sitting around and waiting for it to come to him, he's going to go get it. That is his attitude, and this is something that's going to play out for his whole life.
And at this time, being a landman really, this was an analog job in the early 80s, right? Obviously pre-internet. And so this revolved all around local courthouses. And so Aubrey is spending 16 hours a day sitting on courthouse floors with stacks of documents and maps. He's got his peer-to-peer intel gathering network, whether that's geologists in such and such county and really spies in other counties, right? That's a big thing in oil and gas to have your guys spying on competitors and what they're doing. It's really like you have to go dig up the information. He's naturally very good at this. He's a local boy who understands how this works. He's got the Kerr name to put on leases. And at this point in the Aubrey story, it's important to note what he's learning, right? He is not learning how to drill wells. He is learning how to put together a formidable land machine, basically to capture the flag in the big plays. That's what he's learning in his first couple years as a professional. And during this time in the early 80s, when Aubrey's trying to build his landman business, he keeps running into this one guy who's around his age named Tom Moore.
Tom is super interesting, right? Because Tom is very similar to Aubrey in a lot of ways, but also very different and perfectly complementary. And Tom is this guy who grew up in a small town in Oklahoma, who was a great athlete in high school, spent his senior year of high school actually working in the oil fields, and that's how he decides to go study petroleum land management at the University of Oklahoma. And then, similar to Aubrey in his early 20s, he becomes a landman. And whereas Aubrey is this stereotypical, very extroverted salesman, Tom is more introverted, and he's very methodical, very analytical, and he's less comfortable fundraising maybe, but he's also very meticulous, and he's all about execution. And that's why they perfectly complement each other, right? And the thing where they align very closely on is they both work really, really hard. So they're kind of the perfect partnership to stop competing and go do deals together.
Right. And this is one of the great duos in oil and gas history, Tom and Aubrey. And so at this point in 1983, they're running a non-op business at this point, meaning that they're not the ones that are drilling and operating the wells. They're just participating in other people that are drilling and operating the wells. My take is they were not making much money at all during this time period. I'm actually pretty sure that Kate, Aubrey's wife, was the breadwinner during the 80s, which makes sense because the industry was terrible. The oil and gas industry was awful in the 80s. And so they stay in this non-op 50-50 situation until 1989, when they formed Chesapeake Energy together. The legend is that they spent $50,000 and spent it all in the first day to form Chesapeake Energy. One funny thing about Tom and Aubrey is through this whole story that we're going to tell, they never combine offices. They always maintain their separate offices. And in 1989, they formed Chesapeake Energy, and partly because they want to start operating their own wells. So in 1989, they raised their first $1 million. This is their first big, material slug of outside capital. A lot of the marketing materials associated with this $1 million raise were actually citing all the government incentives in place for companies like Chesapeake to go find oil and gas and produce as much as they could because there was a national shortage or fear of one. For example, a lot of their materials talk about a tax credit that effectively increased the natural gas price by up to 50% on certain types of natural gas. So they're able to raise $1 million doing that of outside capital, and then they also end up partnering with the Belfer family.
Did you know who the Belfers were before you dug into this? Because I didn't.
I did not.
Yeah, I had never heard of these guys, and super interesting. The patriarch is this guy Arthur Belfer, who founded Belco Petroleum. He actually started other businesses, but ended up being a prominent oil person in the mid 50s. And he grew it to be a Fortune 500 company by putting together a bunch of leases and drilling for oil and gas in places like Wyoming and even far off places like Peru. And in 1983, he ends up merging the company with a pipeline company called Internorth in Omaha, which then 2 years later, that combined entity ends up merging with another company that might resonate with you called Houston Natural Gas, led by a guy, none other than Ken Lay, which of course then rebrands this merged entity into Enron.
Right. So I think one thing that is interesting about the Aubrey story is a lot of the big names in oil and gas and energy in general are around this story at different points.
Yeah, it's a small world. I think this is true of every industry, but you run into these stories and they all intertwine in some way or another.
In the very late 80s and early 90s, Chesapeake's sort of finding its footing. They've created their company. They've raised $1 million of outside capital. They've got a very prestigious drilling partner in the Belfers. And in February 1993, Chesapeake goes public. They raised $25 million from outside investors. This is their first very big capital raise. Interestingly, they were able to catch a mini trend of small, high growth, natural gas focused companies that were all going public at the same time, which sort of begs the question, why is anybody investing in natural gas, and how does this work? How do they make money?
When you go through the annual report and the filings for their IPO and you start digging into it, you're like, why would you put money into this? But I think what's interesting is then, to consider it more broadly too, not just like, why would you invest in Chesapeake, but why would the Belfers partner with them and put money to work in this time period, into oil and gas? And I think it's a good mental model to load into memory at this point in the story as we start building towards the boom. Investors ultimately put capital to work in any project just to grow their capital base, right? I put $1 in, I get $2 back, and then go find the next productive opportunity to do that all over again. And in this case, with Chesapeake being an energy company needed to spend a lot of money up front, right? To lease and then to drill. And production from those wells will be sold, right? Volume times price. They'll get some revenue. They'll pay whatever their expenses are. And whatever money is left over becomes the capital that goes to the people in charge to figure out what to do, right? You either make a return for your investors or you decide to reinvest it and go fund another project. So the kind of three simple questions that any investor in oil and gas asks themselves as they're evaluating a project is, how good is the rock, right? How much does it cost to acquire the land and to drill wells? And then 3, how much cash can we generate and over what time period? And there's a lot of nuance into how to answer these questions and how to generate consistently good returns doing this, as it's true with anything, but that's basically the game, right?
And so that's exactly what people are doing when they bet on Chesapeake when they go public in February 1993. I thought it was interesting that Chesapeake went public on the NASDAQ. That kind of struck me as weird. But then when you think about it, first of all, they're too small. They're only raising $25 million. This is a small company. They're too small to go on the New York Stock Exchange. And like today, the NASDAQ is for growth stories. And so believe it or not, in 1993, Chesapeake was a growth story. They were part of a mini trend of small, high growth, natural gas focused independents going public at the time. And the story was that the gas market is deregulating and that there's going to be rising demand for natural gas from power plants. And so the expectation from the market was that natural gas prices were going to be not only going up, but really showing their first signs of life ever in the history of natural gas in the US. It's kind of an ugly IPO. Almost all the proceeds are being used to pay back debt. My read is that if they didn't pay back debt with proceeds from this IPO, debt to EBITDA would have been over 5 times at the end of 2023, which is arguably kind of full value. They get a going concern from Arthur Andersen. When you get a going concern, it means that the accountant thinks that you're not going to make it. They think you're insolvent. They think you're going to run out of money. And so actually, funny enough, Chesapeake, instead of dealing with the going concern with Arthur Andersen, they just pivot over to PricewaterhouseCoopers, who doesn't give them a going concern, and they go public with them as their auditor.
Right, as one does.
And then Chesapeake's IPO is actually the worst performing IPO of 1993 for the specific reason that they end up getting unexpectedly ruled against in a lawsuit just a couple weeks after they go public. They get hit with a $2.2 million payout to a plaintiff. And remember, I said earlier that of the $25 million that Chesapeake raised, most of it went to pay back debt. So they don't have a ton of cash. Now all of a sudden they're paying $2.2 million out in a lawsuit. Shareholders sue the company. My understanding is that Aubrey and Tom Ward had to pay that $2.2 million personally to kind of sort of save off the shareholder suits. And so it's not the best start for Chesapeake in the public markets. Another thing to call out in the IPO that'll come up later is as a part of the IPO, Tom and Aubrey both get 2.5% interest in any well Chesapeake drills for the rest of time. It's called the Founders Well Participation Program, and so that's going to come up later. And they have to pay for that, right? It's not free, but every well Chesapeake drills, they can participate up to 2.5% with their own capital. So 1993 is not a great year for Chesapeake. They go public, but it performs terribly, worst performance for the year. But after that, they resolve the lawsuit. Things really start to turn around for Chesapeake. At this point in Chesapeake's life, early mid 90s, Chesapeake and Aubrey they're not doing anything super innovative. They're a regular independent oil and gas company that happens to be more weighted towards natural gas. And Aubrey's reputation at the time is as a great landman, but they're not known for being particularly good or bad at drilling wells, right? These are guys that are really good at land. And so from 93 to 97, the stock and the company do great, but it's not for the reason that the market expected, right? The market at the IPO, the market was expecting natural gas prices to really kind of rip and go much higher, but they don't. Right, natural gas prices don't really move at all. They even go down until about 2000. That's for a couple specific reasons. I mean, whenever it comes to thinking about commodities and price, these are kind of classic supply and demand driven markets. And so, on the supply side, the reason people thought prices were going to go up was that domestic production was falling. But what ended up happening was Canada actually stepped in, and Canada started producing a lot more than expected. And remember, natural gas is not a global market, right? You have to deal with whoever you're landlocked with pipes. And so Canada is really the only country that could supply the U.S. And they do. And so they end up shipping 1 to 2 trillion cubic feet a year of gas, which is 5 to 10% of the market demand, and that's all sort of unexpected. And on the demand side, there was this expectation that power plants, because of the deregulation of the gas markets, were going to be switching away from coal into natural gas. But that doesn't actually happen until much later. It takes about a decade for that to really be in place. And so gas prices remain pretty weak throughout the 90s. Meanwhile, Chesapeake's growing their natural gas production, their revenue, and their EBITDA at about 100% every year between 1993 and 1997. So these guys are growing like crazy, sort of despite the natural gas price not.
They were doubling every year?
Yep.
That's wild. Yeah, I didn't realize that.
Then we get to 1998, which is really a major inflection year for Chesapeake Energy. This is another very hard year for Aubrey and Chesapeake. Gas prices are going to go well below $2 per MCF, probably their lowest point in the 90s. And that's because there was a very moderate winter, which always affects natural gas prices. And the Asian currency crisis and the long-term capital management stuff created some unexpected economic weakness that decreased the demand for natural gas. In the midst of this very low price and near-death experience for the company, actually, Aubrey bets the whole ship on the future of natural gas prices. When he looks out at the world, he sees, okay, natural gas prices are definitely going up now, and he starts pivoting the company from around 60% of their production is natural gas, and in 97, 98 and onward, he's going to move the company towards closer to actually 90% production of natural gas. And he's doing this in 97, 98, which is they're like dismal years for natural gas. So this takes some real sort of bravery. As we study these major market episodes, we're seeing more and more people make these big, bold bets. But let's talk for a second about what Aubrey saw that had him really bet the farm on a commodity price call. The first thing worth noting is that the Department of Energy was projecting a 45% increase in natural gas demand in the sort of medium term, which is a huge increase in demand. But they had been saying that for a long time, right? That was a part of the IPO boom in the early 80s. People had been expecting natural gas demand to increase for a while, and it hadn't. Something I think that is really important about the story and really important about making big, bold bets like Aubrey makes here is that at one point, Aubrey and Tom actually go out to San Jose and they sit down with the executives of Calpine, who is one of the big power generation companies in the U.S. And the Calpine executives lay out their plans in detail, where it becomes clear to Tom and Aubrey that these guys are serious and that they're going to be building a ton of natural gas demand that's going to be coming online in the next couple of years. And actually, their math is that Calpine's additions alone, one company is going to be adding 33% to the demand of for natural gas in the US. And so this is where you start to hear Aubrey say things like the 19th century was the century of coal, the 20th century was the century for oil, and the 21st century is going to be about natural gas. And this is a huge statement, right? Like if you look at the top 10 wealthiest people from the 20th century, 2 or 3 are sort of directly from the oil space, like a Rockefeller. And then, about 7 of them are sort of immediately derivative of the oil space, like a Ford or someone like that. And so what Aubrey's really saying here is that there is now a new platform for wealth generation. It's natural gas, and I'm going to be the king, is what Aubrey is saying now.
And I think this is still playing out. I think this is he's not wrong. I would bet that this is in fact the natural gas century over maybe other energy technologies. And
Right.
it all comes down to energy at the end of the day,
Right.
right? Like you study history, it is all about energy.
Right. And again, he's not a believer in fracking yet. At this point in sort of the early 2000s, his view is that fracking is too expensive. Fracking a horizontal well costs, 10 times as much as just a boring vertical well, and 3 to 5 times as much as a horizontal well that you don't frack. And at this point, to Aubrey at least, it's just not clear that this is repeatable outside of the Barnett. And then one thing that everybody's watching with shale, and I think is still watching, is that the shale wells are different than the legacy vertical wells in that they're declining really, really fast, right? So you've got these very expensive wells that it's not clear that they work yet, and even when they do work, you're getting a 60 to 80% decline in production in the first year, meaning that you better start out super high if you want to have an economic well. So it's not until 2004 that Aubrey and Chesapeake get excited about shale and fracking. And so they're definitely not early adopters of this technology. But here comes Aubrey in 2004, and now he's all in on fracking. He thinks it works. He thinks it's repeatable. Now the guy with the bullhorn in the industry, is saying, "Hey," he's kind of ringing the bell, like this works. We're getting into it. This is sort of the best thing since sliced bread kind of moment for Aubrey McClendon. So put yourself in his shoes in 2004. You'd been correct on your gas call in a really big way, which almost never happens, right? Nobody's ever right about this stuff. Aubrey's right in a huge way. As a result, Chesapeake's doing awesome. They have tons of net income. They're getting into kind of the top 10 natural gas producer in the U.S. The majors still aren't back at this point, and so he's kind of the king, right? Exxon and Chevron aren't there yet. It's just kind of Aubrey and his guys. And now there's a major technology breakthrough right in your lane where you're now allowed to go so much bigger. You're now enabled to go so much bigger than you've ever gone before. You can get 3 to 5 times the amount of natural gas out of every well than you've drilled in the past.
And Matt, even though they had not been early adopters of shale, they were early adopters of all of the technologies that enabled shale, right? Because even in their 1993 annual report, they're talking about horizontal drilling. They're talking about 3D seismic. Shortly thereafter, they start talking about fracking. And so they are very familiar with targeting tight formations, if not, shale, which comes later for them. And so this is sort of, like you said, this is right in their lane. This is perfect for them to just go exploit.
And not only that, but the natural gas futures market at this time is saying you're going to continue to be right for a while. The natural gas futures market has gas prices staying high kind of really through the decade.
And what was the price at this point? Was it like $4?
Yeah, it's kind of $4. There are points here where it seems like even God is on Aubrey's side, right? You have Hurricane Katrina that sends natural gas prices to all-time highs, $15 not long after this.
Forgot about
And so
Katrina.
everything in the mid-2000s is looking up for Chesapeake Energy. And now they believe in shale, and it's a really important part of the story that Aubrey actually thinks they're behind in the shale game. Remember, this guy is very competitive, and he's smart. He doesn't want to be the next Blockbuster or Kodak that gets made irrelevant by his industry taking on a new business model. And so they buy into shale in a big way. They become the fastest land acquirer in the industry because they're trying to get major positions in the primary shale plays. And Aubrey is so perfect for this moment, right? Everybody else, most other people in the oil and gas space are engineers and geologists. They get trained on how to read the reservoirs, and Aubrey is a landman, right? Remember I mentioned in the beginning that what he's been learning his whole career is how to build a land engine and how to get all the best acreage in each play. So in late '04, they make a small shale purchase in the Barnett. They buy Halwood Energy. And then in 2005 is when they start to go really big. They buy Columbia Natural Resources for $3 billion, and they get into the Marcellus.
Which, Matt, if you look at a chart, just to put this into perspective for people that maybe aren't familiar with the various plays, the shale plays, what's really interesting is we're getting about 80% of our gas from shale plays today that we're consuming in the US. And if you look at all the way back in the early 2000s, the first growth play, the first big leg of this shale addition to the gas supply in the US was the Barnett. But as you start moving forward in the projections, the Marcellus is actually the one that takes over. And so the biggest contributor today to US gas supply is the Marcellus play that Chesapeake is getting into here in 2005.
Exactly. And so Chesapeake is an innovator in the sense that they're breaking open the Marcellus, which does become very important. And when you read about AI today and there's no concern about the resource, the electricity, it's because of the Marcellus that we're talking about right now. Post 2004 is when Aubrey kind of really comes into his own on showing his ability to raise money and to spend it to get huge. Before 2004, Chesapeake's spending kind of a couple $100 million a year. After 2004, we're moving into the $2 billion to $4 billion of capital spending every year. And Aubrey earns the title King of Capital. Between 1993 and 2012, Chesapeake has a cash need, right? Cash from operations minus cash from investing on the cash flow statement. They have a cash need of $28 billion across that time period. They only have 1 year in that time period where they don't have to raise outside capital to finance their negative free cash flow, which is a really important point to pause and talk about. When these huge revolutions happen, they require capital. Aubrey is sort of the capital side of the story of the shale revolution. And so it begs the question, how did Aubrey get this all financed? Where did all the capital to plug this $28 billion cash need come from?
Yeah, I think this is a good side note moment because whether you're drilling wells or you're building data centers, right, these projects always require a huge amount of upfront capital. And the company doesn't just have cash laying around that they can just pick up and go invest into projects, right? There's this idea that you have to go tap the capital markets, right? Like this global pool of money that is sitting there waiting for a productive place to go to work, right? To generate returns. And so there are really two ways for a company to fund these projects, right? You can either tap equity markets, which basically means you're selling a percentage of your company, or the other option is debt. And if you go after debt, then you can borrow money and, commit to pay it back at a predetermined time and with a guaranteed rate of return to the lender. Of course, there's also flavors and financial instruments that kind of blend the characteristics of equity and debt. But there's two important caveats to all of this, right? Number one, for somebody to lend you money, if you're going to borrow it, they have to have some level of confidence that you're going to be able to pay it back. And these investors look at cash flows, they look at assets, they look at debt levels in the company. So what else do you have on your balance sheet that you've committed to in terms of liabilities? And then number two, the second caveat is that capital markets are subject to sentiment, right? Which cue the famous quote from Benjamin Graham about the stock market being a voting machine in the short term and a weighing machine in the long term. And so effectively what he means is that capital markets have these narratives that build up, and the way that capital gets allocated oftentimes depends on those narratives. You have stories about the future that may or may not materialize, that may or may not have sound fundamentals, but that often drive where capital ends up flowing towards, right? And so one of the things that makes great fundraisers really special is that they can tell a very compelling story and attract that capital. And they also know how to position themselves almost like a surfer to ride the waves of sentiment that are happening in capital markets. And that was Aubrey's superpower. He was a fantastic gauger of where sentiment was in the capital markets.
And the combination of Aubrey's superpower of fundraising with Shale really created a unique moment in capital markets for the specific reason, right, that Shale very much changed the game for the oil and gas space in a number of ways. But in terms of raising capital, especially debt capital, the major change was that you now had more of a manufacturing process, something that was much more repeatable. So when you think about debt investing and credit investing, that's credit investing is more about investing in value that's already been created. And so before the shale revolution, like it was when people went to drill oil and gas wells, it was unclear if they were going to get anything out of them. After shale, you became very confident that the value was there. It just was underground at the moment, and so these are much more leverageable assets than oil and gas assets were in the past. So how did Chesapeake get this financing done? So first, Chesapeake had what I would call a full flex of regular way capital raising. So looking at their 2010 financial statements, they had $3.7 billion drawn on a $4 billion credit facility with JP Morgan, and that was at LIBOR plus 2%. That's bank debt. They had $6.5 billion via 9 high-yield bonds at a weighted average interest rate of just 7.25%. And this is the market that really opened up to the oil and gas space with shale because, again, it got that repeatability. It got that the value's already there. It's just underground kind of check mark. They had $2.5 billion of 3 convertible notes with mid 2% interest rates. They had 3 issues of preferred stock, and they had their public common stock. They exercised every possible venue for raising regular capital. The only thing that's not in their capital structure that would be considered somewhat normal would be something like a second lien loan from a CLO or something.
So some would label that a complicated balance sheet. Others would call it a very sophisticated balance sheet. But nonetheless, it requires like advanced management to be able to navigate your company with a balance sheet like that.
And I think one really important part of these stories is that the regular way capital markets are not big enough to handle these kinds of major capex revolutions. So Aubrey and Chesapeake ended up going way outside of the regular capital markets and really getting quite creative and innovative in how they funded this $28 billion cash shortfall over this 20-year period. So a couple things that they did that were outside of what would be normal. The first one is what are called cash and carry JVs. They got $10 billion in proceeds from 3 counterparties from this. They did deals with Plains, Statoil, and which is Norway's sovereign oil company, and CNOOC, which is the Chinese sovereign oil company. And all these deals look pretty similar. And so I'll just read off one. But so for Statoil in 2008, GFC year, just keep that in mind. That's how good at doing deals this guy was. The deal was $1.25 billion of cash for 32.5% of Chesapeake's Marcellus position. And then Statoil was going to pay 75% of Chesapeake's drilling costs until Statoil spent $2.125 billion. And none of that was misspoken. That was the real deal. Where usually if you buy 32.5% of the interest in acreage, you pay for 32.5%. In this case, Statoil was going to pay for 2x that.
Yeah. So what's particularly interesting about the Statoil deal in 2008, you brought up the global financial crisis, is that despite there being a massive downturn in the economy, natural gas prices are really high. So we're talking about, $6, $7, $8, where, just a couple of years ago, we were talking about 2005, 2004 timeframe, we were talking about $4 or $5, right? So the natural gas market is still really strong. And moreover, I think these companies that are coming in are all looking for expertise. They're looking for exposure, so they need additional gas reserves, but they also need the expertise because everybody expects that shale will work everywhere else in the world too. And now you have an opportunity to come invest in everybody's preferred market, which is the US, right? The most advanced market with the biggest amount of demand and the most talent and the most capital. And you can go put money to work there in a very safe rule of law environment and then learn how to do shale so you can take it elsewhere, right? So I think that these are very attractive deals for people externally, and everybody is underwriting high commodity prices going forward. And so not only are they getting all this intangible value of the learning curve of shale, but they're also modeling great returns. And that's why they're willing to pay those kinds of prices to come in, right? These are viewed as very valuable assets to go be a part of.
And these cash and carry deals are sort of the marquee deals of the time. These are really big transactions. Aubrey's looking very smart, very sophisticated. There are 2 other major ways that Aubrey financed the company beyond the traditional sort of financings. The second one was what's called volumetric production payments, known as VPPs in the industry.
VPPs.
Yep. And this is essentially where Chesapeake pre-sells a percentage of their gas or oil production in exchange for upfront cash. And so Aubrey loved these because they're not debt, they're not on the balance sheet, and actually just shows up as an inflow in cash from investing on the cash flow statement. And so they raised $6 billion from VPPs. So they were a very big user of VPPs.
Yeah, and the other way too that they did this is that they had these midstream joint ventures, and volume commitments that they would commit to. And so different than the situation we saw in part one with George Mitchell, where there was a pipeline that didn't have enough gas, and then Mitchell found gas and ended up signing an agreement with the pipeline where the pipeline would buy their gas at an elevated price. This is going to be almost the opposite, where if you're an upstream company, if you're Chesapeake and you have this giant asset that you're about to start producing massive amounts of natural gas from, you need infrastructure to get it to market. And in order for that infrastructure to get built, you either have to do it yourself, which again, those are massive capital projects. So not only will you have massive drilling capex, but now you have to go put a bunch of facilities to gather all of this and take it to market. Or you can sign an agreement with a third party, with a midstream company, to come build that infrastructure on your behalf. Now, the caveat there is the midstream company is going to require some commitments from you, because they're not going to put all of this capital in the ground that is going to sit there if you don't ship. And so they're going to require for you to commit to, 10 years, 15 years worth of volumes, so that they know that there's going to be production flowing through those pipelines and that they're going to be paid so that they can generate a return on the capital they put on the ground so that they can get your production to market. So Chesapeake ends up actually investing their own capital to build some of these systems, but then eventually spins those out into their own company, which will IPO eventually in 2010. And Chesapeake will sign up for what's called a volume commitment, minimum volume commitments, so that they can guarantee production flowing through these infrastructure projects. And then that midstream company can go and get the capital that they need, debt capital, to borrow against the cash flows that Chesapeake on the other side is guaranteeing. And by the time this is all said and done, Chesapeake's going to commit to like $20 to $25 billion worth of liabilities that they're going to have in terms of volume commitments in these midstream systems.
Right. Yeah. One of the critiques of Aubrey that's starting to creep up around this time, sort of mid 2000s pre GFC, is that traditional leverage is reasonable, but when you look at all the commitments they're making across all these different weird financing structures, commitments, obligations, debt is starting to look very, very high. But at this point in the story, Aubrey is just the king of the world. Pre GFC, the majors start to come back to the U.S., which means Aubrey gets to basically say, I'm smarter than Exxon and Chevron and all these big wigs there. KKR buys TXU in 2007, the largest LBO ever, and that was also just a natural gas price bet. Warren Buffett buys TXU bonds, so even Warren's a believer in this natural gas story. And so Aubrey's just on top of the world right now. Chesapeake's, a top 10, really a top 5 natural gas producer in the world. He's worth about $3 billion personally. He's got one of the best wine collections on the planet. He's got a map collection that the Library of Congress would love to have. He's got a restaurant empire. He actually buys a chunk of the Seattle Supersonics and moves them to Oklahoma, the Oklahoma City Thunder. At one point, he almost considers building a racetrack with a golf course in the infield, just to kind of give you a sense. Like, people called Aubrey a one-man economic boom for Oklahoma City. The Chesapeake campus itself really was worthy of, it rivaled any Silicon Valley campus. It had childcare, it had massage tables, it had a huge gym. And then on top of all that, Aubrey and Tom they have their own hedge fund their own commodity hedge fund, where they're putting on huge positions in commodities, including natural gas. They're some of the biggest traders in the natural gas market personally, right? Aside from Chesapeake, which is arguably 10% of the market itself. And so at this point in the story, everything is really working for Chesapeake. The gas price story has worked out great. They've sort of stumbled upon a technology revolution that was right in the middle of their space. And then the global financial crisis hits. 2008, 2009 are very rough years for Aubrey. Gas prices collapse from $10 to $2. And one of the things that Aubrey had done that's actually quite normal, there's nothing sort of nefarious about this, is all those wine collections and basketball team purchases, a lot of that was financed by borrowing against his Chesapeake stock. And so the Chesapeake stock came down over 90% in the great financial crisis. And so Aubrey actually gets margin called during this time. He loses all of his Chesapeake stock. This is probably a very embarrassing moment. This is really like a pretty unique loss of wealth in history. Right? There are not many stories of billionaires losing all or most of their wealth when they didn't do anything fraudulent, right? It was just the market.
Maybe put a pin on this piece of the story too, because this is going to come back later to haunt Chesapeake in some ways, because Aubrey not having that big chunky equity stake in the company influences a little bit of the behavior of the board and his ability to influence the direction down the line, which is going to be pretty big.
Right. And on top of all that stuff in 2008, this great success in developing shale, this revolution has now overwhelmed the market. And so Aubrey kind of sowed the seeds of the natural of his own destruction in a sense by being so successful developing shale. At this point, some people are calling Aubrey the Bernie Ebbers of natural gas because he crushed the market, right? He kind of overdid it. Chesapeake and the people following Chesapeake produced too much natural gas, and now natural gas prices are super low, and the market's saying they're going to stay low for a very long time. And so on top of getting margin called at the same time, he's sort of losing a little bit of his luster as a great business person because he ended up being too successful in developing shale.
Yeah, they basically called they called the run up in natural gas prices. They positioned perfectly for it, but then they were the victim of their own success because in these commodity markets, when you start producing so much, inevitably you end up getting a glut of whatever it is you're producing, and then that drives down the price. And so all these high prices that you underwrote that you thought that they were going to be there forever end up falling significantly. And so all this debt and all of the promises that you made are now in trouble.
So post GFC, really, we're still in the GFC. Aubrey has been margin called. He's lost all of his Chesapeake stock, and he goes through this period where he receives a very large compensation package from Chesapeake in 2008, $112 million compensation package. A lot of this is specifically so he can continue to participate in that 2.5% Founders Well program that he got at the IPO. And this becomes a lightning rod situation. If you remember in 2008, executive compensation was sort of the topic du jour. And Aubrey was one of the top 10 compensated executives in the country that year.
And it's interesting too to consider the fact that there was a strong narrative of populist backlash against Wall Street and against big company executives, specifically because of what happened during the global financial crisis and some of the bailouts of Wall Street banks. However, if you fast forward to now and you look at, for example, what just happened with Elon Musk at Tesla and the compensation package that they put through, I think maybe the one piece of nuance I would have on this is looking at the incentive structure and how exactly or what sort of milestones he would have to hit in order to get these really lucrative compensation packages. But I think it's hard to argue against the fact that Aubrey was a significant part of the value creation engine at Chesapeake and therefore required some level of really lucrative incentive structure to make sure that Aubrey stuck around and didn't go do something else.
Yeah, yeah. No, I think the sort of raw number is very high. But yeah, I think you got to look at what was required to get it all. And one of the interesting things about this compensation package is there's actually an HBS case study specifically on the decision the compensation committee made to give him this big of a compensation package in a year when the stock did terribly. The fact that there's a case study makes pretty clear that this is actually not a cut and dry situation where this was there are arguments that Aubrey was worth every dollar of this 112 million. In terms of where we are in the Aubrey story, the really important part about this compensation package and all this stuff is that Aubrey's still in charge at this point. The board is behind him. Aubrey is still the captain of the ship, even though it's been a rough year, even though he lost a lot, and he's standing firm at the wheel. And between 2008 and 2012, Aubrey moves Chesapeake into what he calls their third business model, which he's trying to shift them to liquids, kind of more over to the oil spectrum of the commodity landscape. Because again, gas prices have tanked, and the outlook is that they're not going to be going up for a while. And so he's trying to shift to more of the oil spectrum where prices are very high, and fracking is sort of just starting to work. So that engine is just starting. This is when he does that deal with the Chinese national oil company. That's an Eagleford deal. And he also buys into the Utica at this time. But eventually, board rolls over, and they really kind of grab on to the media assault that's happening against Aubrey. They're calling him the Bernie Ebbers of natural gas. He's actually on the cover of Forbes magazine with the headline "America's Most Reckless Billionaire." in 2011. He's sort of being crucified along with all the other executives in the GFC for being overpaid. And so the board turns on him. They use the media as a way to do it. Also, the stock price is going sideways. Aubrey keeps promising deleveraging and asset sales, and it's just not happening fast enough. Carl Icahn is on the board at this point, so he's kind of a well-known activist. And there's also Southeastern Asset Management. So really, Southeastern and Carl Icahn are kind of the loud people in the room right now, and they want Aubrey gone. And so Aubrey loses his chairmanship of the board and he's forced out of the company.
What's interesting too about this, Matt, is what's going to happen next, because this is the recurring pattern that we've been seeing Aubrey go through his whole life, which is anytime you think that a normal human would be against the ropes and or fall down and maybe not get back up because this is a major loss. This is the company that he founded and now he's getting pushed out of it. He bounces back almost immediately and goes and starts another company to go compete with Chesapeake. Not only that, he puts a billboard like almost right outside the Chesapeake campus recruiting people to come to his new company. But this time he's going to go focus on liquids rich, more oily shale plays. And they're going to develop a whole ecosystem of entities, one for each one of these shale plays to go after with private equity money. And he's going to go turn on the fundraising and the land machine again and go pursue that. Unfortunately, he ran out of time because he ended up passing away in a car crash in 2016. But he was ready to do all over again.
Yeah, and so Aubrey sadly passes away in 2016. He's very fondly remembered by the people who were close to him. A lot of people actually compare Aubrey to Bill Clinton in the specific way that Bill Clinton and Aubrey McClendon are these really high profile guys who are very well known for making you feel like you're the only person in the room when you're with them. And Aubrey actually did this to me one time, believe it or not. When he was raising money for an entity called Larchmont, I walked up to him after his presentation to kind of pick up the bank book and go back and start doing analysis on the company. And he sees me wearing an oil and gas tie. And so he compliments me on this tie I'm wearing. It's an oil and gas tie. It's got like rigs on it. And if you ever worked in oil and gas, you know that the ties that are oil themed are a big deal.
Love those.
And he says, he compliments me on my tie. And then he goes on to say, I was actually behind you in line when you got that tie at the Christmas party where they were handing them out a couple months prior. And I've never felt more seen, right? Like this guy's like a celebrity, especially to me, in my mid early 20s trying to learn the space. Aubrey McClendon's the superstar guy. And he's saying he remembers me being in line, right? So I actually experienced sort of the love of this guy. And I think most people that were close to him kind of felt similarly about him.
Yeah, I think so too. He was a legend.
So that's the story of Aubrey McClendon. Lessons learned. One of the major lessons I learned from this episode was you have a technology breakthrough that affects capital markets. When there's a technology breakthrough, obviously it's going to get financed by the capital markets. But it's interesting to take a step back and think about like how and why. And so in this case, you had a technology breakthrough that was extremely creditworthy, right? Which is kind of probably strange, right? Like when the internet was founded, we learned in the tech and telecom series, all the internet stuff was funded with equity. In this case, you had a technology breakthrough that made the oil reserves in the ground like highly leverageable because again, because it was more manufacturing and the value was almost certainly there, it just happened to be underground. These assets could incur a ton of debt. Once you bring debt into the picture, you get access to like a much broader swath of sort of creative financings to get it all done. And so, one of the major lessons here is, just kind of how is the tech breakthrough going to access and impact and change the capital markets, and what is the nature of the technology that warrants, that conclusion is one major lesson.
Yeah, I think somewhat related to that. To me, people forget about cycles sometimes. They forget that markets work in cycles. And so to me, one of the critical takeaways here is that the underwriting for most of these projects was predicated on commodity prices remaining high. And these were fair assumptions in the face of structural, supply and demand dynamics that implied you were going to have a consistent shortfall and consistent needs for these supplies that were coming online. However, I think people underestimated the power of technology to drive productivity in some of these plays. And I think people also underestimated the willingness of the capital markets to finance production growth in the face of downside cases for commodity prices that implied that you could impair capital if things went sideways, if things didn't go quite as according to plan as you might be underwriting, right? So to me, one of the core takeaways is you got to remember that these markets work in cycles. And when they go up, they can always come down on the other side.
Yeah, it's interesting to think about the tech productivity comment, right? Because in this case, you had a technology that is rapidly improving, goes from discovery to taking over the whole market in a couple year period. But then part of the reason that that happened is because of the way that technology breakthrough interacted with capital markets. Because the technology breakthrough was so leverageable, meaning so debt worthy, it's almost like the range of capital solutions that match and can fit in the box of a new technology almost determine like how fast and how hard and how big it can get quickly. And in this case, you had a technology revolution where the technology is changing fast and it has access to every kind of capital imaginable, which isn't true for a lot of other kinds of technology
Right.
breakthroughs.
Well, and building on that, there's a piece that we didn't touch on in the story, which is speaking of access to capital. If you think about the history of Chesapeake from 1993 when they IPO'd all the way through when Aubrey leaves in 2013, they have multiple experiences where the company's against the ropes and they could have conceivably gone bankrupt, but they had access to capital. Through Aubrey's kind of superpower fundraising, he figured out where to get the capital from and to keep going. And every time they go through one of these cycles at Chesapeake, the company gets stronger, it gets bigger, and it keeps growing. And it kind of goes into the next game, more powerful. And that doesn't actually happen for Chesapeake after this period. And I think a lot of it has to do with the fact that the board not only forces Aubrey to leave, but right before that, the board also forces Aubrey to not raise additional equity to fund the cash shortfall that they had at that particular moment, but rather forced him to sell assets. And if you look at the assets that Chesapeake was forced to sell at the time, and in particular, I'm thinking of the 900,000 plus or minus acres that they had in the Permian, that is a massive asset sale at a point in time where we're about 5 or 6 years away from the Permian becoming the growth engine of U.S. oil and gas, right? And so you try to play out a different scenario and imagine a world in which Chesapeake, instead of selling assets to fund itself at that point in time in like the 2012 period, instead they go just raise equity. As a shareholder, you might get a little bit diluted, but not only do you still live to fight another day, you retain an asset base that is going to go on to become extremely valuable over time. And I would even go on and speculate that Chesapeake could be the biggest oil company in the U.S. today had they figured out a way to fundraise and retain that asset base the way that they had from 2008 through 2011 with those JVs and the different creative financing structures.
The other major thing that stood out to me in this Aubrey story that I didn't appreciate beforehand was, they built a bunch of conviction around this natural gas commodity price call that they were making. A lot like people build conviction about other things. We saw a lot of people build conviction about the telecom stuff and the tech and telecom cycle, et cetera. I just thought it was so important to punch on that, Tom and Aubrey actually went to San Jose and sat down with the Calpine executives and had them walk them through their plans and really like kind of look them in the eye and got a sense for what was happening at the ground level. I thought my guess is that's not very common to kind of go actually touch the market and not just read the newspaper or listen to the memes. So that was another major takeaway is when you make a big call, you got to go talk to the source.
Yeah. Validate the signal, right? That's how you build conviction.
Right.
Yeah. To me, maybe the last thing I would share that comes to mind for me is great ideas always require great execution, but they also require good market timing. And I think Chesapeake and Aubrey had a lot of good timing over the years, maybe some bad timing, but ultimately ran out of runway and didn't quite deliver on the ultimate promise of what that company could have become. But nonetheless, I think the vision of natural gas becoming the growth engine is coming to fruition. That is the world that we're living in today.
Yeah, I think he was right. All right.
Should we leave it there?
Let's do it.
All right.
All right. Thanks for listening. If you enjoyed this, the best way to help us is to share this with anyone you think you might like it and to leave us a 5-star rating on Spotify or Apple Podcasts. And of course, tune in for part 3 of the Shale Revolution next week. Thanks for listening.
Thanks, guys. See you, Matt.